All right, so we finished the week on a strong note, and so what I decided to do here today, just like we do most years, barring any significant craziness next week, which is unlikely, and next week is typically a slow week in the markets. I decided today to kind of do a little bit longer rendition than normal and kind of do a end of the year and then a 2024 outlook video. So this for those who want some more details on that, my portfolio management class this week, my technical analysis class this week, and even in the Q&A session that we had yesterday for our premium subscribers, I spent a lot of time more detailed than in this video, but on what I expect next year and why I expect it. But I talk about how we finished the year, kind of how unique the finish was. How that relates to some other years, and then especially what we expect to see, what I expect to see in 2024, based off of other years similar to 2024, and also based off of how we are finishing this year in such a unique way. So we'll talk about kind of the how bullish we expect to be in the next year, and break that all down from a technical perspective. And like I said, for reasons, kind of macro reasons why. For example, this year, I expected it to be I expected that we would get rate cuts this year, and we didn't. And I kind of said early in the year that if we don't get rate cuts, that's the bullish narrative. The bullish case that a lot of people talked about was, okay, we're going to get rate cuts and the market will rally really well. Well, I always said that the market will rally if we don't get rate cuts, and we didn't. We actually got a couple rate hikes more this year than what we expected. Never did get any rate cuts by the end of the year, as was largely expected early on in the year, late last year. And we ended up with a 20% return for the year as a result of that. Not going to be the case next year, and we'll talk about that why. And like I said, I broke that down quite a bit in my classes here this week for our premium subscribers. But I'll give you a kind of a taste of that here in today's video. Like I said, the last video of the year. So thank you for those who aren't going to make it all the way to the end. Thank you for those who watch these videos day in and day out. I appreciate it. And those who like the videos, I appreciate it. Those who share and retweet and comment on the videos. Even if you don't agree with me, that's fine, right? The fact that you're watching means a lot, and I really appreciate that. So let's go ahead and get started. Today is Friday, December the 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it really helps us out a lot. That's why we always ask for it. It helps get our content out to all of our followers on those platforms. Our goal is to get to 100 likes on Twitter every day. That's a easy goal to reach. Sometimes it hasn't been lately for me, but it goes a long way for us. Like I said, I appreciate those who do like these day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see here, we finished the week strong again. This is multiple times we finished the week near the highs of the week. Obviously, when you're on a bullish rally, that ends up being the case more often than not. The lows of the week end up being early. In this case, we had a low on Wednesday because of that sharp drop, kind of similar to what we saw over here. That was actually a Thursday low point there, but same kind of idea. But we did have the intermediate line still above the 90th percentile, has been now for weeks. That's a long, long extended stretch for the intermediate line to be that high up above. Let me get rid of this 95th percentile line. That's kind of, there we go. The market sentiment's rising. It's above the 70th percentile now. It's easily in bullish territory, making its way up towards the upper reversal zone. After a brief little dip into bearish territory, the near-term line is back into bullish territory. So, again, this is about all the near-term. We've had two little near-term dips. I mean, even off of this level here, this near-term rally, well, it got to the 38th percentile. Remember, that one didn't even touch the 23rd percentile, not even close. It's a little bit more. One-day move got to the 38th percentile of that near-term rally, and then and now is bouncing back up. Now the question will be, of course, again, we've been above 2.5% also for a very long time. You can see that's not very common to be. Let's go back to more of a bullish time frame. It's not very common to be above the 2.5 percentile for a very long time. 2.5% above the 30-day moving average, which you can kind of see that upper dotted line. So very, very, needless to say, right? We've been saying this for quite a while. This is one of the more parabolic moves that we've seen in the S&P, and really since probably the beginning of 2018 was the last time we had this parabolic of a move. If you were to come back over here, you can kind of see we were pretty bullish, and then we just went boom up to the upside right at the very beginning of the calendar year. From the start of the year on, we just took off like a rocket. We were above the 90th percentile for a good long stretch there too. We were above the 2.5% mark for a good stretch at the end. So very kind of similar type move that we saw then, we're seeing kind of right now. The momentum lines in the middle of the chart, so again, not really that bullish. So again, without the momentum line getting up into, you can see all these other near-term rallies all kind of started with a good strong momentum surge into the upper reversal zone. This one, of course, so far has not had that kind of a surge. So again, is kind of like over here, that those near-term rallies that don't get preceded by these momentum surges don't really get too bullish, as you can see there, and then again here. Neither one of these two near-term rallies were that bullish at all, and that ended up being kind of surrounded by that big down day, kind of similar to what we're seeing right now. So that's the S&P. Of course, the Russell 2000, which has been playing catch-up for a while here, basically trading inside the upper range of that long upper shadow from Wednesday that ended up being the down day. Of course, the near-term line bounced up too. Momentum line again, not starting this near-term rally with a surge. We've had multiple clusters on the Russell. We're 9% above the 30-day moving average in the 92nd percentile this past year. The peak being this pre-options expiration cluster that we had. Its market sentiment line just crossed the midpoint of the chart. It's not in bullish territory yet. The NASDAQ 100, which has been fueling a lot of this rise initially, has not been as bullish here lately, but again, same pattern. Near-term line bouncing, momentum line not surging to start it. It didn't do very much of a surge on that last one either. That's really the Russell's kind of fueled this latest post-FOMC move in the markets. It hasn't really been, the NASDAQ's followed, but it hasn't really been what the pusher like it was early on over here. It was really pushing it hard initially. And then, of course, the Dow Jones Industrial Average, which has kind of been doing its own thing. Its near-term line has not jumped up into bullish territory yet, though its market, everything else looks very similar and has been above the 90th percentile. It has had a cluster during this time as well, and again, almost 4% above the 30-day moving average. Very high levels compared to the rest of the year above that 30-day. Let's look at the weekly chart for both of these, and you can see how we finished like the near-term. Well, let's go to the S&P 500 first. You can see the S&P 500 here with the intermediate line way up there, 96th percentile on the weekly chart. Momentum line's kind of giving us a divergence with that near-term line starting to show a little bit of weakness. Not surprising. I mean, we've had a pretty good surge here for 8 weeks now, 8-week streak in a row. We haven't had an 8-week streak in a row for quite some time. We're 7% above, well above the 5% mark. So that's a pretty good sign for the S&P. The Russell 2000, which is really most of its gains have been in the last 2 weeks, right? It actually had a down week in the last 8, unlike the S&P. That's why I said first it was really the NASDAQ that kind of surged, fueled this, and then it's been the Russell here lately playing catch up to try to catch up to where the rest of the indexes are. It's because of that, its intermediate line still not in the reversal zone yet. We'll see if it gets there. Like last couple of times we got into bullish territory, it did not get there here, and it barely got there for a week there. We were already dropping. So we'll see if that ends up being the case, or if this ends up being some kind of fake out. We are 10% above the 30-week moving average, which is the highest level we've been above it since since the reopening trade post the 2020 election, and then into 2021 when the economy vaccine was rolled out and we had the quote-unquote reopening trade. The NASDAQ 100 has had that 8-week streak in a row, had a cluster last week. It's the only one that had a cluster last week, and then again is really bullish here. Near-term line, intermediate line, both above, right around the 95th percentile. So showing some strength there, coming off of that cluster. Looking at some of the other weekly charts, like the S&P on this chart here again. Remember, last week we had that long upper shadow. Especially on the Russell 2000, we had that really long upper shadow, but we followed it up on the Russell in particular with one of its bigger candles that we've seen in a while. And again, a golden cross, but really strong candle, like way bigger than what we saw in August. It's one of the biggest candles we've seen for quite some time. We have to go back. You can see right over into some of these post-COVID candles that we've seen. Very strong candle. We had another big one over there coming off of the election of 2016, but very strong candle. Again, we're not starting this move with that candle, so you wonder, which usually happens, but when you have a move, you can end it, especially with the long upper shadow. You can end it with that, and that's kind of the concern here, to see whether or not we will end up finishing this move. The high point you can see is 2042. We close at 2033. So this close is at 2012. So we'll have a little bit of a higher close, but we'll have a much smaller body next week. Considering the average is so high, you'll probably drop below the average on the size of the weekly candle. The S&P 500 already has done it once. And we'll see if it ends up doing it again next week. The expectation is, we had our higher Heikin-Ashi close, but next week I would expect the candle size of the body will get much smaller, especially considering next week will be a holiday week, only 4 trading sessions, and probably very low volume, as not a lot of participation typically exists during this particular week of the year going into January. Looking at the 3 green arrow charts, of course, we still have 3 green arrows on all the daily charts. We have 1 on the S&P, red arrow on the diamonds in the S&P, but 3 green arrows here on the Qs. When you look at their weekly versions, you can see 3 green arrows there. The MACD histogram is still rising. Same thing here. Same thing over here. And then, of course, the same thing here. So 3 green arrows across the board on all these indexes. Strong momentum as we're approaching new highs. We have already eclipsed these 3-year highs on the diamonds. So we have new highs up there. We have not yet on the S&P, and we have not anywhere close to the Russell's 3-year highs. But at least we are, as of right now, breaching through this August high from last year, and then the NASDAQ 100 does have a new 3-year high there. 3 green arrows across the board. And looking at the 2-line versions of these charts, you can see the convergence and the convergence period as the MACD is actually dropping. We actually have lower highs with easily higher highs, so there's a divergence setting up there. You can see, remember the volume that we've had on these up days versus getting the arrows on the down days, kind of a sign of exhaustion there. So we are exhausting right now on the S&P, and the IWM is kind of the same thing. We had some good strong volume pre-options expiration coming out of the FOMC meeting, and now you wonder again the exhaustion with the MACD peak as high as it is in the 96th percentile. Looking at the weekly version, and you can see we're above the 200-week moving average. The 8 and 17-week exponential moving average is crossing above the 30 and the 50. We're above, of course, the point of control. Strong MACD. Here's your S&P. Very strong MACD, and again you can see all the moving averages rising, and they're all in their order, right? 8, 17, 30, 50, 200. So all nice little order there, above the point of control, which is a lot higher on the S&P than it is on the any of the other indexes. Let's look at the. I want to look at the hull. The hull. So the hull's been green pretty much this entire time. A few days of red, and a couple of days of the parabolic SAR switching, but it didn't really switch very much. And now we're again in convergence mode here, so kind of slowing down. IWM Also got up to the, currently it's the 98th percentile in terms of how far away it is from its 200-day hull, way up there. And you can see I only had 1 day of red on its hull, on the 20-day hull, and the parabolic stars never did flip. So we'll see, how that ends up playing out here over the next little bit. It's needless to say, very, very, parabolic move there. As you can see, the 20-week hull is turned up with some of the bigger candles. And we've talked about, the size of that candle there, very, very strong size, as we are above the 200-week hull. We have already been about, in fact, the 200-week hull on the S&P is green and it's rising. You can see we're in the 90th percentile in terms of how far above the 200-week hull we are for the last 5 years, with the divergence setting up on the Hakunashi differential there. Now let's take a look at the DMI. We've been talking about this parabolic move, getting almost to 50, got up to 49.7 on the ADX. Anything about 40, but getting to 50 is just, the last time we were even close to 50, I think we were above it, like the 52 was 2018, the early part of 2018. That's also the last time we had so many arrows here, 8 arrows, with the negative indicator below the 10th percentile. So very, very big move. Remember, IWM did not join the party until late, but it is caught up in a big time way. It's also very, it's not common to end the year with the ADX above 40. It's not common. It's not very common to get it above 40 at all. Just to kind of give you an idea of how often the ADX gets above 40 from a calendar year standpoint. So if I were to go about the last 20 years, so 2023, again, we had 2 instances of the ADX getting above 40. 2022, we didn't have any, none, because we were in a correction, right? 2021, we didn't have any instances of the ADX getting above, so no parabolic moves to the upside. 2020, we had the one right there going into September. We had the one instance of the ADX getting above 40 of a parabolic move, in orange arrows down there. 2019, you notice we didn't have any. One towards the end. It was right at the very beginning of 2020. We barely got above 40, and of course we saw the environment that set us up for. 2018, we had one at the very beginning of the year, which is kind of 2017. We got way up here. And then again, this was a negative move, but no more bullish moves. 2017, of course, the ending of that move. We also had started the year with one and kind of ended 2016 almost with one there. And then 2015, 16 we didn't have any others. 2015 we didn't have any others. 2014 we didn't have any others. 2013 we didn't have any. These were all steady, strong moves, but no parabolic moves to the upside. 2012 we didn't have any up there. 2011 we didn't have any. The ADX getting above 40 in green, right, on bullish moves. 2010 we didn't have any, only one bearish one. We tend to get a lot more bearish moves here. 2009 we didn't have any above 40. It was nice and steady, no parabolic moves there. Of course, 2008 we didn't have any. We had actually 3 to the downside, well, 2, and then the third one is in early 2009. Almost a third one at the beginning of 2008. 2007, we didn't have any moves to the upside, parabolic moves to the upside. 2006, we didn't have any. So you see how rare it is to get just one of these in a calendar year. It's extremely rare to get 2 of them in the same calendar year, and especially considering that we're ending the calendar year on one. Because we've seen every time we get them, we tend to the market consolidates these parabolic moves, in not a very comfortable way. So we'll most likely start off 2011 as we generally do. The beginning of the 2024, sorry, the beginning of the year is seasonally a weak time of year. So there's 3 periods of seasonal weakness. One is early, one is kind of in late spring, early summer, and then one is in fall, right? Those are the 3 periods of seasonal weakness that we get, and that's followed by some strength there in April, late March, early April, some strength there in July through middle of August, and then some strength from early October on. So more than likely, because of how we're finishing the year on a parabolic run, that this typical seasonal weakness in the early part of this year, of the year, most likely will hit us again this year, right, 2024. And then the question is how strong will the weakness be? I think by the time we get to September and we have rate cuts, that's again rate cuts are a sign of a late cycle market, not an early cycle. They're a sign of late cycle. Markets tend to be finishing their long-term bullish moves by the time the Fed's cutting rates, and that appears to be going to be the case this year. Now, the market's pricing in those rate cuts by March, right? And they're pricing in. I mean, the Fed's got 75 basis points of projected cuts next year. The Fed themselves do. The market's pricing in all 75 of those cuts by June's meeting, and then another 75 after into the end of the year. So, if we're at that point, which I don't think we will, but if we're at that point, then it's going to be really hard to replicate 24% gain with 150 basis points of cuts, considering that generally precedes downturns in the market. So now if we can keep it to 25 basis points of cuts, or 50 by the end of the year, and they all come in the fourth quarter of the year, then I think we can be okay. We'll have a good year, and it probably won't be a double-digit return, but it'll probably end up being at least a single-digit return, which is generally on average what you have here over the last 20 years, when you count all the down years in there as well. So now we don't get single-digit returns very often, but considering the parabolic run we're finishing this year on, it makes it really hard to say, because of how high the basis is, it's going to be really hard for the calendar year return next year to replicate that. Because remember, we actually came into this year on a low point. The market had already dropped. The Nasdaq was at its right near its 52-week lows at the end of 2023. So it makes this kind of run, a lot easier to occur, which for the Nasdaq was 54%, because you had a low basis to start this calendar year. This year, obviously, we have a much higher basis. This 54% return on an annual basis here. If I were to go to the Nasdaq 100. At 50 some odd percent, you can see it rivals the 2009 low point coming off of that bear market low, rivals the 2003 return coming off of that bear market low point. I mean, these were full-on bear markets. We were way below the 200-week moving average on these. We barely touched the 200-week moving average on this one. And we still got a similar type of return off of that. And you can see it's hard to replicate that return the next year, not even close, right? And then, of course, the 100% return, actually an 85, then 100% return in those two calendar years is why we had such, 3 consecutive years of the Nasdaq losing a third of its value. So big move this year, but again, because we're coming off of a low, and now we're finishing this year on a parabolic run. It's Ichimoku trend. We're not quite above 10, but we were briefly above 10 there. You can see the trend noise balance is above 90, so pretty extreme from that regard there. Again, that's not how we started the year, right? We started the year last year right here. We started the year with a bearish trend going on, so nothing even close. On a weekly chart, you can see as well. Here's the weekly chart here. So here's going into 2023. We had a bearish trend going, and now we, are, after being so strong. Oh, this is a monthly. There we go. Finally, here's coming into 2023. We had kind of a year of no trend at all, and then now here we are, at least on a weak bullish trend to start this year. But of course, on the daily version of this, very strong bullish trend, right? Much different than what we saw, and really much different than how we ended that year. We were on a bullish move that year. Here is this 2000 going into 2020 was pretty similar. 2019 we had a relatively parabolic move going on there, and you saw again we had some strength, with a divergent high point, and then you saw what ended up happening once COVID happened. I mean, COVID in itself doesn't make it drop 30%. It's the rally that you had that preceded it that made the drop so dramatic once we had that COVID virus there. So similar type of setup. Of course, I also the 2018 makes this move right over here. Again, going into 2018, the trend quality was at 20, eventually getting up to over 30. So I mean, that was the most parabolic I've ever seen. An index going into the end of the year, 95 on the noise balance. And of course, we saw what ended up happening for that whole calendar year. It ended up being a down year because of how we finished 2017. Made it very hard to replicate that return again in 2018. Your RSI and your CCI, let's go out here to the end of last year. You can see the RSI was green, but it was at the low end of its bullish range. And then you can see the CCI was on a bearish run, right? If you look at the weekly version, we weren't above 100 yet. Now we are above 100, so we're in a bullish run here. So I can color these really quick. There we go. So now we're on a bullish move, and you can see, and we're not at the bottom end of this bullish range. We're at the top end or at the bottom end of the bullish range, or at the top end of the bullish range. And same thing here on the weekly version as well. So you see the big difference here between how we finished the year. In this case, we got above 80. Like, again, we haven't finished a year above 80 since 2019, where we kind of finished the year with a move, not necessarily above 80, but almost easily above 70. And then, of course, you saw what ended up happening. Again, the first part of that year, we were set up for weakness, not that much weakness, but we were so bullish and so parabolic that it was hard not to have. And then, for the first 9 months of the year, we were flat. 10 months of the year, we were flat before that last rally gave us a positive return for 2020. Looking at the Bollinger Bands and the Keltner channels, you can see we are rising back up. We're still in the upper quartile. Sorry, we're not. We had this big move up above the band, huge move up above the bandwidth. Again, a exhaustion type signal. It's not common to be that far up above the bandwidth, especially without the momentum being strong. The momentum surge occurred early, and then we've had this latest surge here without a whole lot of momentum, but exhaustion. Still above the Keltner channel, in between the Keltner channel and the Bollinger Band, have been above the Keltner channel for quite a while. And again, finishing with, it was interesting, for most of this move, we were not in the upper quartile of the bandwidth very much, nowhere close to the 100th percentile. Then all of a sudden, not only do we get to the 100th percentile, we got way up above it before coming back. IWM kind of looks the same. Again, we weren't really up, in the upper quartile for a good chunk of time until right here at the end. Then we exploded up above it, and exploded above, significantly above the Keltner channel. We've been above the Keltner channel for a good chunk of time, but that move right there got way up above it. The second day got way up above the Keltner channel. We're still strongly above. Again, with as strong as that momentum is, kind of the strongest momentum we've seen, even stronger than this August one. Again, kind of exhaustion type moves there, and green boxes across the board here on all these different time frames. Let's take a look at the volatility and how we finished the week on the VIX. You can see after a surge there on Wednesday, all the way up to 14.5. Then we pulled back to just barely over 13, and we're still, after we got easily below the 80% mark right before that surge. And then we took off, right, and got above the 85%. We're still, closing at a relatively low level. The VVIX came down too, but not as much. The correlation between the VVIX and the VIX is not as strong. We've had the big dip to strong negative levels, and we still haven't really corrected that. So, we see how easily the VIX rallied. I mean, again, we're due for a move on the VIX to the upside. We're very strongly below all of its average values over whatever time frame you look at here, except for the short term, because of that strong move higher, we jumped up above, and that you can see we've been in this convergence mode, kind of rounding out a low point as we typically do on the VIX. You tend to round out these lows instead of like V bottoms like the S&P gets. These tend to have kind of rounded out low points with a long periods of this convergence pattern where you're above moving averages down here, but you're still below moving averages up here until this week, right? And we'll see. We came back down today. We'll see if we get back below those short-term average values by throughout a really what should be a very quiet week next week. Needless to say, though, the ranges have been very small. The volumes have come back below average after those two post FOMC days and then options expiration day. You can see the one above average day was the above average range, and above average volume was the down day, and we've come right back down to below average ranges. The ATR has come back easily above 4 again, so it was below 4 for a little bit of time. The average, the relative normalized ATR over here is at the 90% mark, or the 0.9% mark, sorry. And volumes, you can see, are starting to pick up a little bit. I mean, those are, again, not something you typically see at the end of bullish moves. These end of these bullish moves, they tend to come down to their lowest levels. And so we're starting to pick up as we're peaking here with higher ranges and higher volumes. Is a little bit of a sign of another sign of exhaustion that we have, and you can see with the intraday range that we didn't really get to, but no new high point, and we came off of those, filled in the gaps the last couple of days. The Arun indicator is still fine. And again, once it gets below 70 is when you start to worry about the reversal. By the end of next week, the low point will still be a little bit. It'll still be around here. It'll still be a little bit higher. Last week's range pretty much is the same as the 4-week range, a little bit more to the upside this week, and the last couple of weeks before that was a little bit to the downside. But we're going to lose some of this here and move it up just a little bit more. But it kind of goes to show, again, we're very top heavy again because we just make a big move and then don't go anywhere, and we don't have a very good margin of safety below this week's low point. So that's something to kind of watch to see. That might be a catalyst for some volatility in the short term over the next 2 weeks, right? Again, I don't expect a big move next week, but once we do come back on the 2nd of next year, that's going to be a margin of safety that we want to, because a lot of this volume will come off. The point of control will probably come up here somewhere, and then we'll have a very, very poor margin of safety in the short term. All right, so let's talk about what's driving this price action, especially going into a new year. Of course, interest rates will be the big thing. And really quickly, I wanted to talk about this tweet that I posted out there. If you don't follow me on Twitter, I put this out there a couple days ago. There's been, since these two red bars right here, that represents 1973-74 bear market, right? So from that time frame forward, we've had 49 years, right? 28 of those years we've had 10% or more gains. That's what the blue bar represents. So you can see more often than not, 57% of the time we have gains of 10% or higher in the calendar year. 10% or higher. We've had in the last 1, 2, 3, 4, 5, 6, 7 years, we've had 5 of the last 7. So that's well above the average, right? So 5 out of 7, we're at 71%. We've had, in that same time frame, we've had 12 down years. So out of 40 of the 49 years have either been 10% or higher gains, or a down year. And you can see the down years were either bear markets, so the 77, 78 bear market right there, the 81, 82 bear market right there, the 2000 to 2002 bear market, and these were two very weak bear markets because the CAPE ratio was already very low. Then you had the 2000. These two are two bigger bear markets, like the 73, 74, because their CAPE ratios were a lot higher, similar to now. And then you had 6 others. So those are 6 years. The 1, 2, 3, 4, 5, 6 years in those 4 bear markets. The other 6 years came during corrections. In 1990, we had a correction there. 1994, we had that famous soft landing correction. 2011, 2015, 2018. There's 2011, 2015, 2018, and then 2022 were the other six negative years there. So you get the idea that it's when you have a down year, it's because you're either in a bear market or, like we've seen, two years of the past 2018. 2018, 19, 20, 21, 22. So two of the last 5 years have been, pretty significant correction years. Remember, 2018 was a year coming off of a parabolic move, right? We had a parabolic move that actually stretched into the beginning of 2018. So out of the 49 years, only 9 of them did we have a gain of less than 10%. And all these small gain years were lots of pullbacks, right? We had lots of pullbacks, a correction or two. And then again, you can also see, being an election year, a lot of these years were election years. Even if they weren't, like 2020 right here was an election year, and it wasn't below 10%, but you can see it was significantly below the returns that kind of surrounded it. So considering that we're in 2008, of course, being one of the more famous election down years that we've had. 2000, of course, was a down year. 2004 was this less than 10% year. 2008, 2012, there was a smaller year compared to what we had seen, above 10%, but smaller compared to what we had seen. So we're going into an election year. Now, another factor to consider is we're going into a year where there's expected to be rate cuts. Again, 2008 was the last year that we had significant rate cuts over a period of time. 2018, we had rate hikes, but the next year, 2019, we only had a couple of rate cuts. So we're not expected to just have a couple of rate cuts. So like 1994, over here, we had some rate hikes, and in 95, we had just a couple of rate cuts. Those were both really big years, 2019, 1995 and 2019, where we had just a few cuts coming off of a rate hike cycle. So I think a lot of people are suggesting that, maybe next year will be like that. We'll have a few rate cuts. Remember, the Fed's targeting 75 basis points, but that's not what the market's targeting, right? The market's targeting a lot more than that. In fact, as I mentioned, there is a high probability that we'll get our first rate cut by March of next year. There is a 88% chance that we'll get it by March. There is a 100, there's a 89.8% chance that we'll have all 3 of those cuts by the June meeting. So we'll get a cut March, May, and June, 25 basis points each. And of course, by December, you're looking at high probability, 100% odds of 3, 99.8% odds of 4, what that 3.1, so 96.9% chance of 5 cuts. And then you're looking at, roughly, what would that be, 71, about 80% chance of 6. So, we have an 80% chance that we'll have 6 cuts by next year. That's what this line will represent, 6 cuts. So move back down to 4 and 4.25%. Of course, the bond market's not pricing that in yet. The short-term bond markets, the long-term has been, but you have tremendous spreads between the 10-year and the 3-month. To kind of give you an idea, the last time we had a soft landing right here, we closed the 10-year 3-month. At the end of that hike cycle, we were at 134 basis points. So kind of give you an idea if I were to show you a little bit closer here on this chart. Going into the end of 19, the December, last time we had a hike, the 10-year 3-month, was at 216 basis points positive. Here in July, the last time we had a rate hike, and this one was in July, we were at 158 basis points. It's kind of to the downside, which is where we're at right now. So much different environment. Last time we had rate cuts in 95, by the end of the year, we were actually closer to 0. Rate cuts generally make the yield spread go higher. That was a soft landing because we were still above 200 basis points by the end of the hike cycle. All the other hike cycles, we end up with negative yield curves. That was a soft landing because that rate hike cycle did not end up with a negative yield curve. And so we think, okay, well, maybe this will be a soft landing like 1994, the last time we had one. But not only do we have not only do we not have a positive yield spread like the last soft landing, but we have a historically low negative yield spread, and not just on the 10-year, but on the 2-year. So if I look at the 2-year, which did get down to pretty significant lows, down to the 70s. But again, if I look at the end of that hike cycle, we were positive, 15 basis points. Barely positive, but we were positive. And the hike cycle by end of December moved it up a little bit, never did get back 100 basis points. Again, we just ended this hike cycle with a yield spread that was negative. And not only negative, but near 100 basis points. Again, the lowest. So the bond market's not pricing in a soft landing like it did in 94, 95. The bond market is pricing in a significantly hard landing. And so the question is, if we get those 6 basis points, again, typically, as I mentioned, typically we have, in the election years, we have single-digit returns, maybe double-digit returns, but far less double-digit returns and definitely not at 20% gains, smaller than what we have seen. That's already an issue with the election year next year, considering that we actually have 2 incumbents. We generally don't get that, right? We have the incumbent running, which is generally positive for that incumbent, but we have another candidate who has been a winner previously running too. So it's almost like we have 2 incumbents running again, most likely, right? It's obviously not official, but most likely that's the case. So it's going to really throw a wrench into like the uncertainty of next year. That's why markets are have such lower returns in election years, because we spend 11 months of that year or 10 months of that year with a high degree of uncertainty. And markets don't like uncertainty, regardless of the candidate or political affiliation, whatever. It doesn't matter. Markets just do not like uncertainty. So you add that on to the fact that the Fed's expected to cut rates, which is traditionally not a bullish sign, off of it at a very, very low negative yield spread. And you add on to that we're ending this year on a rare parabolic move. It's rare just to get one, but not only did we get one, it's the second one of the year, and they've kind of come pretty close to each other, and we're ending the calendar year on it. So we're starting the calendar year with about as high of a basis as you could possibly get. Because a lot of these returns depends upon the basis, right? How low were you? How high were you when you started the year relative to, obviously you generally finish the year at the highs of the year, but how bullish was it? Was it how strong were these indicators? How significant were the trends? And this year, again, very similar to 1999 for the NASDAQ 100, was the last time I've seen a market that parabolic going into the end of the year. And that was also going into an election year. And that was also going into the year where the Fed would start cutting interest rates in 2000. So very, very similar time frame. The election year, a parabolic run at the end of the previous year, and a parabolic run at the end of the previous year, and rate cuts, right, that are widely expected to start next year. Those are all, and you can see 2000 ultimately ended up being that one negative down year. This is on the S&P, but especially was negative. Remember, it lost a third of its value on the NASDAQ 100. And keep in mind, too, another post I tweeted out earlier this month, and that is right here. FXI has been in a bear market, right? This is the bear market when you get below its 200-week moving average. So FXI has been retesting its 2008 lows. It's been in a bear market this entire time. But what's interesting is, and you can see the year that we've had, this is this calendar year, and India's been doing very well, Italy's been doing very well, but China's been a huge outlier to the downside. But generally speaking, there have been times where there's been negative correlations between FXI and the S&P 500, and this is over 13 weeks, so this would be a quarterly correlation. And you can see the SPY is the purple line, and you can see all the blue arrows where we've had the negative correlations have all kind of gone into correction there, gone into this correction here. We saw that bearish move coming out of that period of negative correlation. And then this bearish move we had coming out of that period of negative correlation, that bearish move there that we had this year, and potentially now, right? That correlation continues to be pretty darn negative. When you look at this is the current, that was a couple of weeks ago. This is the current correlation. Let me zoom this out. You can see just how, let me look at that. Just tremendous moved in the opposite direction. But let me zoom it out to the 13 weeks. So this is 10 weeks there. But this is the quarter, right? 13 week is a quarter. And it's a very significant negative correlation that we've seen that generally precedes periods of weakness. That's the point of this tweet. Generally precedes periods of weakness in the S&P 500 as they return to a positive correlation. So, that's another factor going into the end of the year that we have staring us down the barrel in 2024, starting here pretty much at the beginning of the year. Another factor, a couple of factors we have going in. Again, we're generally not above 80 very often at all. Last time we were above 80, again, at the beginning of 2018, we saw what ended up happening. We were above 80 at the beginning of 2020. We saw what ended up happening for that calendar year. And now we're at above 80 going into the beginning of this year. All right, so, we've seen this, like we've seen the skew. The skew is not generally above getting above 150, but we got above 150 here at the end of the year. It's, we were above 155 over here at the end of 2021, and we went into the calendar year. So we're not above 150 now. We just, it was brief there. The average, of course, is above 140 going into the end of the year, and that's not very common to be that, to have the skew, the average, a 20-day average of the skew be that strong. Another thing too is our new highs and new lows. We had a big surge. We're still, we're at 200 plus. That's the highest that the average has gotten over this entire year. This is the highest level that it's gotten over this year. We had the highest surge in new highs and new lows this year. It's gotten up to higher levels. We've been flirting a couple of times with getting below that. That's something to kind of watch out for going into the new year. But here's the other factor. Again, going into a new year, right? This is, it's one thing in the middle of a year, but going into the beginning of the year, it's not very common to be above, 450 or even 400. Again, not even like 2018, you go above 400. 2020, right over here, you got above 400 barely. I mean, we're above 450 again going into a new year. It's last year going into this year here, you can see we were right around 300. The average was down. The average is above 400. The average is at its highest level that we've seen since going way back over here. So very, very strong breadth from that standpoint. The McClellan oscillator is also at almost above that 1,000 mark. Here it is, 917. We're only a couple of days away of next week getting above. Most likely we'll get above 1,000 by the end of the week. Again, that's not common to start a calendar year. See, even 2021, you can see the McClellan oscillator was actually negative going into 2022. That kind of gives you an idea of the type of breadth we had there. Going into 2000 and going into 2020, we had strong breadth. We saw what ended up happening. You go a little bit further out. 2018, we didn't have nearly a strong breadth. Even all the way up to this peak, we didn't have the strong breadth, and we saw what ended up happening there. So, needless to say, like here we were going into this year, we were at slightly negative. Going into next year, we're going to be at 1,000. Most likely, we will be at above 1,000. That's a high mark to start a calendar year with. Again, this kind of shows a level of exhaustion to finish a year. Sets up a high basis for the next calendar year. It makes it very difficult to have a double-digit or more return. More likely, especially considering all the other factors we've talked about, more likely at best we'll have a single-digit return, which means we'll have a year of what was the last time we had a small positive. was right here in 2016. Before that, it was here in 2007. Of course, we all know what 2007 looked like. Before that was 2004 and 2005. Well, to kind of give you an idea of what those years look like, going all the way out, let's go all the way up to 2000. But this is what those years look like. In fact, let's do this. Let's go to this chart here, and let's go to a weekly chart. So 2016, you can see what that year looked like. We started the year with the end of that correction. We were in a correction already. It was kind of a bifurcated correction. We had a couple pullbacks down to the 50-week moving average during the summer, during the fall, and we had a single-digit return as a result. Period of a lot of volatility in that year. Going out to 2007, the last time before that, of course, we had a pullback early. We had a pullback late summer. We had a pullback in the fall. That kind of started the correction that ultimately led to the bear market. That was a single-digit return. 2004 and 2005, you can see we were still coming off of the bear market low of 03. We had some pullbacks in all the typical seasonal times of the year. Same thing with 2005. We didn't have any parabolic moves to the upside. We had lots of pullbacks and corrections. Considering that we've had 2 parabolic runs this year, makes it far less likely we get another one next year. So more than likely, at best, if we end up with a positive single-digit return, and that was an election year too, right, 2004. At best, we're looking for a year of volatility. At worst, it would be a year that could spark, like 2007 and like 2000, that could spark the beginnings of something more than just a pullback or correction. All right, so for our trade idea of the day, I want to take a look at Disney. Disney obviously has been in the headlines for a lot of different reasons, but the stock price has kind of had a bad year as a result of that, going from a peak earlier on its kind of post earnings at 117 on the open, 118, all the way down to a low point this year of 78, so below 80. So pretty significant decline that we're starting to pull itself out of. Big surge in momentum here late in the year, and then now a little bit of a pullback, a bull tag, light pink shading and yellow line, intermediate line crossing below market sentiment, short-term sentiment bearish, but not too strongly bearish. Momentum has hit extremes a couple of times, but the near-term line's not very strongly bearish, setting up for what could be a reversal to the upside. Let's take a look at some of the other pullback indicators. You can see some transition candles here over the past few weeks. None of them significantly bearish on their regular candles, so not likely to turn into a consolidation, more likely to turn into a kind of a move back up, considering that was a move going into those patterns. From a 3 green arrow standpoint, we obviously have 3 red arrows. I think that's can be a pretty significant bullish pattern when you get 3 red arrows there, especially when you don't follow through on it over the next couple of days. When you look at the 2-line version of that, you can see that we are still, despite the pullback to the 30-day moving average, are still above the 200, and we're just basically filling in a gap between the 30 and the 50, and really nothing much more than that. Still above the point of control, still so in the upper half of its value area. The MACD is slightly negative, but not, again, slightly negative. We've had the strongest surge in momentum to the downside now. And again, after the peak, the low point, and you typically get the low point in the MACD, and you wonder if you're going to get that pretty soon. Considering also the stochastics is not in bearish territory there, and really none of these other oscillators are either. They're at the low end of their bullish moves, but not necessarily going into bearish territory. Same thing here. Still easily above 40, still easily above that minus 100 down there. And then looking at the Ichimoku cloud, we're still above the cloud. We don't have that strong trend anymore, but again, we're still above. We're still showing positive patterns here. And then finally, looking at the Bollinger Bands and the Keltner channel, we are not in that lowest quartile, and the bands are inside the Keltners, but we're not. Very, very weak bearish momentum that we're already starting to transition towards bullish momentum. So as a result, I decided to do a long call spread on this and be a little bit aggressive, selling the 96, buying the 94, gives me and position sizing for my normal position size, so half of what my normal position size is. For a directional trade, that's my normal size, and then getting about a 3-to-1 reward to risk ratio. And I got some flexibility. I've got some time, because as time passes, as you can see, that gray box gets smaller. So it doesn't have to immediately work right now. I've got some time to kind of let it work with some flexibility right there, and still get a pretty decent reward for a very small risk that we're taking on the trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching today, and really for watching all of 2023. I appreciate it as always. Have a great rest of your holiday weekend. Make sure you like us on YouTube and comment, and as well as like us on Twitter and Facebook as well. But have a great holiday season. Happy holidays. Merry Christmas. Happy New Year to all of you, to you and your families. And we'll see everybody back again on January 2nd, and we'll kick off 2024 together. Thanks again, everyone. We'll see you next time.